Major funding for these broadcasts is made possible by grants from Chase Commercial Term Lending and New York Community Bank, M&T Bank, Perfect Building Maintenance, Capital One Bank, the Wyckoff Group, Greenberg Traurig. Additional funding is provided by grants from AKA Hotels, Corman Communities, Aerial Property Advisors, AVR Realty Company, Bank of America Merrill Lynch, Bank Leumi USA, Briarwood Organization, CBRE, Citizens Bank, Colliers International NYC, CPEX Real Estate Services, Cushman & Wakefield, Customers Bank, DDG, Dime Savings Bank of Williamsburg, Douglaston Development, Levine Builders, Fisher Brothers, First Nationwide Title Agency, Flushing Bank, Foley & Lardner, Friedman LLP, Handler Real Estate Organization, HAP Investment Developers, Herrick Feinstein, Investors Bank, James D. Kuhn Real Estate Institute at Syracuse University, James Orphanides, Chairman USRealty.com, John Katsimides, Red Apple Group, Kilroy Architectural Windows, New York's Window Company, Madison Realty Capital, Massey-Knackle Realty Services, Matone Group, Mercantile Commerce Bank, Meridian Capital Group, Newmark Grubb Knight Frank, New Banks, MHP Real Estate Services, People's United Bank, SJP Properties, Sterling National Bank, Sterling Risk, Stonehenge Partners, TD Bank, Terra CRG, The Continuum Company, CUNY TV Foundation, the Moynihan Group, Urban American, and These Friends.
Everybody's looking to buy real estate today. People are very interested in it. But, there's banks. Then I was talking a couple weeks ago on my show about crowdfunding, EB5s. And then there's what we would call as specialty lenders, people who could do short-term lending, unique type of lending, and a variety of other types of financing. So today I've assembled a group of specialty lenders to provide their insight on the market today. We have Thanh Bui, who is the managing director and one of the partners at Clarion Partners. Gregg Winter, who is the co-founder and CEO of the W Financial Fund. Ronnie Levine, who is the senior managing director at Meridian Capital. Josh Zegen, who is the co-founder and managing member at Madison Realty Capital. And last but not least, Marc Mendelsohn, who's the co-founder at the Bluestone Group. So what would you call yourself? A mezz lender or?
We do primarily mezz lending.
And for my audience, explain what mezz is, because we like inside baseball to be brought out.
Sure. It's the subordinate piece or the piece right behind the senior loan. So we're sandwiched in between the senior loan and the equity, ending at about, say, 80% loan to value in the capital structure.
And what type of assets in the real estate world do you like? Is there 5 core assets?
We like cash paying assets, any and all, but mostly office, retail, multifamily, industrial, hotels.
Now you bring up an interesting subject. You like cash paying assets. So we're talking about real estate that's in business, no transition, as opposed to you'll do a variety of things. Both of you will do non-cash assets. What's your favorite today? Your favorite type of asset to finance?
We finance multi-office, retail, industrial, and hotel, but I would say probably about 40 to 50% of what we do has a multifamily component to it. But we're a special situation lender in general. Typically focused on the middle market, and our average deal size is between, I would say, $10 and $50 million. So that's been an area that we've focused on, which is, I would say, larger than the family office, but lower than some of the big
But we were saying over here from Clarion, they want cash flow. They want to make sure that there's cash being paid. You, from what I'm hearing, you can accrue. You know,
Well, we're a basis-driven investor, so that's really the most important thing from our standpoint. We typically like to be about 65% of underlying real estate value, and we're also an owner and developer, so we really understand it from the underlying real estate side, and we're not constrained by debt service coverage or things like that. It's really a price point. Where do we want to be on a specific asset?
and Mark, well, what would you say? How would you categorize yourself on the Bluestone Capital, which is more as opposed to the Bluestone?
We're more in the 1 to 10 range on the loans. It gives us a little bit of advantage because it's not just people who need short-term or other situations. There are a lot of lenders who just don't do loans that small, and it complicates a lot of things for a lot of people, borrowers. So we'll do those loans, and we're really New York-based, New York City-based even, I would say. We'll do any asset type literally in New York City because that's, we're also, owners and developers, so we really understand the value, and we'll lend based on value. Debt service really is not an issue for us. We can either create an interest reserve that'll cover the loan up front, or will accrue. We have no issue with accruing payments and back-ending the entire payoff.
Gregg?
And W Financial is purely a lender. We're not also owners at this point of the real estate. And I would say we're involved in the value creation stage. Guys who are buying mostly mixed use and multifamily buildings where there's going to be a value add that occurs rapidly.
This is a big discussion that everyone always brings out. And anyone who wants to bring it up and answer it would be the key. What do we consider value add, and how do we value add? Because you're making loans to make these properties value add. For my viewers, what is value add?
Well, it's really creating additional value through whether it's tenant buyouts, whether it's releasing, whether it's construction, whether it's, air right purchases. There's always some additional value created in the business plan, which is really, in many ways you're banking on the operator to execute. And a lot of deals that we do, we don't typically, we're lending on an as-is basis, and then there's the value add component where we're traditionally giving good news money on. So we really look at it from a as-is and an as sort of stabilized kind of basis.
I mean, many people come directly to Josh or, or to Gregg or to Mark, but in many instances, the customer comes to you and says, where should I go? How do you make the determination of who's the value add? How do you make the determination if you should go to Clarion or another mezz lender in your position?
Sure. I mean, we close loans with probably well over 100 lenders in any given year. So, we have a very good understanding of who's looking to do what and what the proper fit would be. I mean, we would look at the transaction and determine, first of all, what's the timing? How quickly does it need to close? How much equity does the sponsor have available to put into the project? What, so are they looking to lever at 60%, 70%, 80%? So really, the first thing we do is try to understand the business plan and the needs of the client, and then we know the right fit generally for what they're looking for. So I think the key is really understand their needs and then marry them up with the proper source of capital.
You raise your money through institutional investors. Josh raises his money through institutional. Gregg raises his money more from family offices and high net worth individuals, and you raise your money through individuals and high net worth situations. When you're doing a loan, how do you, the important situation of a transaction is the timing to get it done.
Sure.
That's why people, to go to a bank, you have a certain time period that takes, and it's a different case. How fast can you turn over a loan in case somebody has a good piece of property or something over there?
Well, if it's something in the New York metro area, typically, and we've done literally billions of dollars of deals in this area, so we typically know the market so well that it could be as soon as a few days, but that's not the average. The average is typically, I would say, 2 to 3 weeks.
Gregg?
I would say, my partner, David Hayden, and our senior loan officer, Jared Chockett, really specialize in the New York type of phenomenon where contracts are time of the essence. There are very short closing time frames, especially if you're going to be able to negotiate favorable terms on a purchase. David just sent out an email today regarding a $17 million loan that we closed in literally less than 2 days from the time the term sheet was signed. It was a development site in Flushing being purchased for $53 million, so there was plenty of actual equity going into the deal. And they had spoken to the borrower.
You know, when I hear something like that, I mean, it's great that one can turn over a transaction in a period of time, but there are always moving parts. You know, there are title insurance questions, there's environmental situations that could be
Right.
around there. How do you, all of you, how do you get comfort that something doesn't show up that could blow up that
We
transaction?
did a lot quickly, I mean, on that point.
We, because our capital is institution and our investment structures are, and strategies are very institutional, we always hire third parties, and those third parties can take 2 to 3 weeks. On average, really, a deal closes anywhere between 30 to 45 days if it's under contract by the borrower and such. And so also as a mezz lender, we also do value-added transactions as well. And those take a little bit longer because you really have to investigate the business plan of the borrower and make sure that it works and such. And so on average, we can do this as quickly as 30 days. But again, waiting for third parties and such, that takes a little bit of time as well. Clarion is an owner and operator of 1,100 properties nationally. So if there is a property that we have lost, for example, because we're bidding it as well, but it went another direction and we're lending on that property, we probably have a lot more insight into that asset just because we ran it through the process as an equity owner and potential purchaser. That cuts down on the due diligence time as well. So
I would also say, Michael, that normally if you're closing a loan in 2 days, something happened.
Right.
Meaning that there was probably another loan that fell out. So normally what happens, and we've closed several loans with W literally in less than a week, so that's not an aberration. I mean, I don't think that they're looking to advertise we closed in 3 days, but we've done several. But normally what happens is a lender fell out of bed, so you're inheriting the third-party reports. You're usually coming to them with you know, an engineering and environmental report that was done for a previous lender. There may be an appraisal that can be leveraged. So they're getting, you know, they're not starting from a blank piece of paper and closing in 2 days. Because if you think about it, there would be no reason to close a loan in 2 days. I mean, even in New York, the fast-paced people go hard and they got to close in 30 days. I mean, so there's normally a little bit more runway. So if you're closing in 2 days, it's generally a situation where something else fell out of bed.
How do people find out about the world of specialty lending? You know, we were talking in the crowdfunding show that there are probably 100 crowdfunding companies who've just been created, and they're all relatively less than 2 years old. And some of them, you know, they're advertised, you know, you Google the company and it says short-term interim lenders or something like that. I mean, is there advertising? Do you do Google ads? Do you have social media? I mean, how important does that phenomenon, which is very important in the crowdfunding mechanism, have an effect on your type of business today?
Well, I think, you know, when we first started 10 years ago, it was a huge, you know, component to it, a lot of advertising. After being in business for 10 years, a lot of it is the fact that we provided this certainty of execution for so many years. People know about, you know, who we are, they know where to find us for this type of deal. But we do a lot of marketing, advertising, brokers, attorneys, you know, direct borrowers, direct developers, a lot of repeat transactions with specific borrowers as well.
Marc?
We're mostly referral based. A lot of the attorneys that we deal with in all different aspects bring us a lot of those deals. Brokers, you know, people in general who know us in the industry that we do the lending, they'll come to us directly. You know, we haven't done much, if any, advertising.
Our fund is almost 12 years old, so like Josh is saying, there's a lot of repeat business. There's a lot of word of mouth from attorneys, accountants, of course, developers, owners. The word gets out that you can execute, and there is certainty of execution. I think that's the most important thing.
yeah, I would echo that. Clarion Partners has been around for 32 years, and my business partner, Drew Fung, and I have been in the mezz space for 16, 17 years, so there's a lot of experience and surety of execution, and so the broker community knows that as well as the borrowing community.
One of the things besides the crowdfunding that I brought up, you know, today we have the mortgage REITs who are out there, you know, the Starwood, the Anomaly, you know, and others. How active are these publicly held companies who, you know, they have to answer to the SEC? Are they active in the specialty interim quick lending business running?
They're very active. I mean, you've got North Stars of the world, and there's a lot of finance companies that I'll call them. Some of them are REIT structure, some of them are more finance company structure. But generally, what's differentiating, I think, the crew here is how low they'll go down, how small they'll go on loan size. A lot of the lenders that you're talking about, Starwoods of the world and North Star and Annaly, they're not looking at generally loans less than $20 million. And they usually are not closing in the time frames. I mean, they're probably more in the 30-day. They need 30 days, generally speaking. But they can move fast. There's exceptions. But I think really the differentiator is the speed and also the loan size. They're generally not playing on the real small end of the spectrum.
I've also found, I was just going to say that the minimum interest period that someone like that demands
lockout,
is typically a lot longer.
For my viewers, explain a traditional structure of a loan. Let's say, hypothetically, the banks really aren't interested in this type of construction loan or something. How you would structure a loan and how the interest reserves and so on.
One example, we did a deal in Williamsburg where someone bought a piece of property for $35 million. We provided $18 million on a land loan at the time. And the borrower started funding the project out of cash to get things moving. Recently, they came back to us for an $80 million construction loan, and we're providing that. They, we're far down the line, plans approved, everything's been done, they've been moving. So that's sort of like the type of deal that we do. Now, why does someone come to us for that deal? Well, traditional banks are really have pulled back in middle market construction lending, and we found that that's a big opportunity for someone like ourselves today, just given the regulatory environment.
Now, how long of a loan is it, and do you structure reserving for the interest and guarantees and other?
So in that particular case, we had a partial guarantee. It was a 2-year loan with an extension option, and we are reserving for part of the interest there. Obviously, they have to hit specific milestones to continue having advancements of funds, but that's the way we structured that commitment.
Now, are you doing construction also, Gregg?
We rarely do ground up construction. We've done a couple of them. Much more typical for us would be a rehab kind of a loan, which again plays into the whole theme of value-added properties. So for us, typically the rate would be between, say, 9.5% and 10.5% with 2 points for a 1-year interest-only loan. Typically, there's a 6-month minimum for interest, and we'll hold back reserves for various things. It could be a CapEx reserve, it could be an interest reserve, either a full or partial interest reserve, or a tenant buyout reserve, so that we know there's no guesswork about knowing that the project is adequately capitalized.
Marc?
Yeah, I mean, we're very similar. We'll do more rehab rather than ground up. We've done a very similar loan to what Josh just said, but on a much lower scale. The guy bought a building for $1 million in the Bushwick area, and it's become a very hot neighborhood. 6 family, got renovating the property in a $400,000 or $500,000 construction budget. And just the constriction of a construction loan from a regular lender to do a small deal like that with draws and reporting prohibits the timing of it, and they're in and out in a year. So they'll come to us, we'll put up the $1 million, put $200,000 in reserve. They need 50 grand, they'll call us, we just finished the kitchens, we just finished the floors. We'll release the 50, we'll go down there, we'll look at it. We're more fluid that way and more entrepreneurial in that sense.
As an institutional lender, that's not really your market?
We actually do selectively ground up, depending on the market and the product type. We do value added as well, but as a mezz lender, we definitely build in an interest reserve. So the senior lender, which is typically a bank in this instance, would leave off at about 60-65%, and we'd take it to maybe 75 or so, 80% loan to cost. And obviously, once they add the value, the LTV comes down. But building in an interest reserve to help us through kind of the transition period.
Yeah, I mean, in that structure where mezz is coming into a construction loan, I mean, where we get involved in trying to help our clients structure these deals is, are you funding all of your mezz first, or are you going to fund pari passu with the senior loan? I mean, these are all kind of the nuances in structure that really make a difference.
Yeah, I mean, from your borrower's perspective, it's better to have the mezz go in, or the opposite way, but the banks typically want the mezz to go in first.
Right, so we've been successful in structuring where the bank will allow the mezz lender to fund pari passu, which is, lowers the cost of capital to the borrower on a blended basis. And I think on more of the specialty finance construction deals, there's no set formula. I think every one of these guys probably structures their deals a little bit differently, but from the brokerage perspective, what we look for is, when you say a holdback, is that funded at closing and they're paying interest on their future draws, or are you funding them in the future?
Typically, yeah, it's funded at closing.
It's funded into an escrow.
Right, so I know that you have the
Negative
ability
are
to
as
potentially
borrowers.
fund draws. That's really where the nuances come in. Are you paying interest on all the loan dollars day one? Are you funding them over time? And so we'll work with the client to run the math on the different structures and figure out, what's the best structure.
I hear other emerging neighborhoods, and there are different asset classes. And we were talking prior to the show that certain people are a little worried about certain asset classes because they don't, like hospitality is a great asset class, but it's an operating business. It's it's not multifamily that people you have a vacancy of 4% in the country because of that. How do you look at different type of assets in different worlds? I mean, retail is always, you have retail, you have industrial, you have office, and so on. Which assets is your favorite, and which one's one that you're most cautious about?
Well, I guess it depends on what your strategy is too. If you're building ground up, multifamilies right now in the outer boroughs makes a lot of sense. It may not make sense in Arizona, for example.
No, I'm talking more in our local geographics.
Sure. So multifamily in the outer boroughs obviously makes a lot of sense. Clarion just bought a property in Williamsburg, for example, multifamily. We have a research group, and our research group takes a look at the various property types all over the U.S. And multifamily, you hear a lot about overbuilding and such. It's still actually in check in most major markets, so that's an asset class that we really like a lot. You don't see a lot of office construction clearly in the New York marketplace, but industrial is also an asset class that we really like in the region as well.
I mean, there's clearly the most liquidity for multifamily. I mean, certainly in this market. I mean, I think the large construction loan that you guys are doing, it's a great location, a great asset, but I think the reason that we're probably with you as opposed to a more conventional lender is because it's primarily a hotel. So hospitality is one of the sectors of the market that there's not a lot of liquidity for. So I think that's where you have a great opportunity to put out a safe loan and get a nice rate of return.
But as I just brought out before, hospitality is an operating business. It's like, one of the businesses, whenever I do a show on the restaurant business, and I ask the restaurant owners, which banks lend you money? They said, no. The answer is simple, none. Because it's a very violent industry. Too many of them fail over here. Hotels, right now, it's fine because business is doing well. But one of the biggest negatives to the hospitality business in New York and around the country is Airbnb, because they are creating additional rooms and they are having an effect on the occupancy, the occupancy and the daily rate.
Well, they're like Amazon to the retail business, the same basic thing. So, I mean, in our case also, we shy away really from doing much with hotels, anything with an operating business inside. And we really focus on the mixed use, the multifamily, and also retail to a lesser degree. Some of the things we've done together with retail.
Yeah, look, I mean, in New York, when you have a vacancy in retail, you as opposed to other markets in the country, I mean, there's a pretty good certainty. You can peg within a pretty tight range what the rent will be and kind of how quickly that's going to stay vacant.
We're seeing a large predominance today of health facilities. I mean, there's Blink, there's, Planet Fitness and all the rest. How do you look at, or how have lenders looked at this with regard to that? Because, the business model is very interesting because somebody who's paying $20, $30 a month really continue. And these places operate because they say, it's my credit card. Now, you also look at it, it's a difficult operating business. Have you ever financed any in the health facilities or the luxury gyms?
We have not in our buildings.
So, I mean, we have not necessarily as a specific, just a gym, but typically when we look at something like that, we really think about the costs that are being put in by that gym. What, are they can we use that for another gym that may go in? So, how applicable would that be if we had to take over.
They're rent replaceable.
and I've done shows on this. One of the new emerging trends in healthcare is the the city MD, the urgent care centers. But it is a new trend. It's around there. It's not proven, but and it's a specialty because they have to build out. It's not only retail. It's a lot of plumbing. It's a lot of office space and others. Have you looked at that type of market, the healthcare market and the urgent care?
It's typically a great use because the hospitals are so backed up with emergency rooms, so it's a just easier alternative, and it drives other tenants around that kind of tenant. So I mean that's a good trend, if anything.
It's a viable business because they're actually taking pure retail space in a lot of locations, and they could actually get into a community facility designation where there'd be less competition. I mean, I've seen them on my block right next to banks, and we have in the neighborhood on 3rd Avenue. I mean, there's a few of them. So they're paying retail rents where they could be in community facility probably paying less.
Here's an interesting thing, and I know you've been working on it, Ronnie, in a number of places. The conversion of certain types of real estate, which may have been hospitals in the past. I think, Josh, you've done that. How do you look at conversions of these type of things to residential today?
So I would say, no one hospital kind of is the same. So the deal we did on Queens Boulevard happened to have been a great property because it had lots of exposure, lots of windows, great light and air, and it made for a great conversion given the layout. So like as a lender, I'm really looking at that and saying, well, how well is this going to transform to a mixed-use property? And the value of that property is really driven by what, how many units, what you can do, how many bedrooms, what the renovations will look like. And we really think about it from an owner's perspective when we're valuing the cost to complete a project like that.
There's been talk that the condo market is getting a little frothy in the New York area. How any thoughts on, as a lender, on new condos?
I mean, in our case, I'd say the majority of the value add deals that we do in Manhattan, and most of them in Brooklyn, some of them in Queens, are going to be rental buildings. In some cases, the exit will be condo sales. But where the kinds of loans that we are doing are not at the top of the market. They're not the $3,000 a square foot types of condos.
So I think, 26 minutes, 28 minutes, you get a lot of ideas. And I think my viewers have got some good ideas on what's happening and alternatives of where to go, and that there's money is out there. It's, there's more money that's plentiful out there. And I'd like to thank Thanh, Gregg, Ronnie, Josh, and Marc, and I'll see you next week.